Hello guys, welcome back to Ride On Academia. We are still on our series on the partnership account. Today we are going to be looking at the Goodwill account, all right? We're going to be looking at the Goodwill account. Now, when we talk about the goodwill, all right, the goodwill is that commercial advantage that a business has over another business in the same line, all right. When two businesses or more, when two or more businesses are in the same line of are doing the same thing, right? When we have two or more people doing the same business or they are into the same business, and then a particular business has a commercial advantage over another. When we say commercial advantage, we are saying that what makes that business to sell more than another business, all right? Now, when a business has commercial advantage over another business, then we now say that that business has what is called goodwill, all right? So the value of that's commercial advantage that a firm has over another is what we call goodwill, all right? Now, goodwill could be as a result of the location of the business, okay, where the business is located, or the prices as well as quality of goods and services render, okay, or even the reputation of the person, the reputation of the owner of the business, all right. Now, in accounting, we try to value this commercial advantage, we try to value goodwill, all right. So today we're going to be looking at the goodwill account. Although the goodwill may not really be, it's not really opened, or it's not really considered every year like we do in for normal other accounts, all right. It's not really considered yearly like we do for other accounts, but the business is considered in certain situations, all right. The goodwill is considered in certain situations, okay, and those situations could be as a result of the admission of a new partner, okay. When we want to admit or accept a new member into the partnership business, there's a need to value goodwill, all right. Also, when a partner is retiring, like is leaving the business, or a partner dies, okay, we also need to value goodwill. And also, when we want to change the already agreed profit sharing ratio, we need to value our goodwill, right? So it's not really opened or considered on a normal basis, only on this certain situations, all right. So today we're going to be looking at the goodwill account, and we're going to be trying to consider these three situations one way or the other, okay, and then we'll know what the goodwill account will be looking like, all right. Now, still on the goodwill account, we have two instances, all right. We have to, when we're operating the goodwill account, we have two instances. The first instance, which we'll be treating in this video, is when goodwill is retained in the books of accounts, all right. That is after we have valued our goodwill. How we want to retain that goodwill in the book of account, we want it to be part of our account. How do we treat that? All right. The next instance is going to be when goodwill is not to be retained in the account, all right. That means after we have already valued our goodwill, okay, we don't want to keep it in the book of record. We want to write goodwill off, okay. That means we want to, like, is another word is when goodwill is written off, okay. We want to write off our goodwill after we have valued it. So this particular video will be looking at when goodwill is retained in the account, all right. So we'll be taking a particular illustration and then we'll be solving it together. All right, welcome back. So we're going to be taking a quick illustration, and in this illustration we'll be considering the admission of a new partner, all right. We'll be considering the admission of a new partner, and then, like I said, the first instance is when goodwill is to be retained in the book. Okay. We have that A and B had been in partnership business, sharing profit and losses in the ratio 2:1 respectively, all right. Now, as December 1996, 31st December, okay, that's at the end of the year 1996, the balance sheet of the partnership was as follows, all right. Now we have the fixed assets, that's our non-current assets, right. We have the value of land and building to be 5,250 naira. We have the value of plant and machinery to be 3,075 naira, right. Now, for our current assets, we have our stock. Now, like I said, the only stock you can see or you can find in your balance sheet is your closing stock, right. So the value of our closing stock is 4,500 naira, and then we have that debtors value is 3,000 naira, and then we are going to be lessing a provision for doubtful debt, which is 150 naira, to give us a net debtors value of 2,850 naira, all right. Now we have that the cash at bank, that is our bank balance, okay, is 300 naira, And then we have that our current liability, that is the creditor, is 3,975 naira, giving us, when we deduct, okay, we have a working capital of 3,675 naira, all right. And then lastly, we have our financed by. Now we have the capital accounts. For A, we have 8,500, and then for B, we have 3,500, all right. Now, on the 1st of January 1997, C was admitted into the partnership to take 1/5 of profit, all right, to take 1/5 of profit, while the relative profit sharing ratio of A and B remains the same. That is, A and we are still having that ratio of 2:1, all right, but we have to be adjusting that percentage right now. Okay, remains the same. Now C paid the sum of 4,500 for his capital, all right. Now the goodwill of the firm was valued at 6,000 naira. Like I said, this video is about how we are going to be valuing goodwill in the book of account, all right. So the goodwill was valued at 6,000 naira, and then we are asked to show the ledger entries necessary upon the admission of C, all right. So we're going to be doing we're going to be showing the ledger entries. Basically, our focus is on the goodwill account, all right. Our focus is on the goodwill account. Okay, now when we want to work with goodwill, we have to look at the old profit sharing ratio. All right, we'll be working with the old profit sharing ratio, and then that's what we'll be using to divide the goodwill value, okay, among the previous partners, that is the old partners, right. We'll be dividing that goodwill because they are the ones that own that goodwill, all right. They are the one that will benefit from that goodwill. So we have to divide that goodwill value among the old partners in the old profit sharing ratio before we now take in the new partner, all right. So this is our old profit sharing ratio for your A, and then for your B, we have 2:1, all right. That is, A is collecting double of whatever that B has, all right, or whatever value that B has, A is going to be taking double of it, all right. So when we want to prepare our goodwill account, goodwill is an account that has a direct impact on the capital account, all right. Goodwill has a direct impact on the capital account. So the first one we're going to be doing, preparing our goodwill account, this is for A and B, all right. That is the previous partners. They are the only people that can benefit from that goodwill, all right. So for our A and B, our goodwill, this is our goodwill account. Like, we are asked to show the ledger entry, right. So we are going to be using our ledger principle, right. Now goodwill is an asset, an intangible asset, all right. So for every increase in asset, what we do is that we debit, okay, what we do with debit, and then for every increase in capital or liability, we'll be crediting. Like I said, the goodwill account has a direct impact on capital account. That means as goodwill increases, it will also be increasing capital, right. As goodwill increases, it also increases capital. Now we are going to be using, like I said, our ledger, right. For every debit entry, we have a corresponding credit entry, all right. Now this is our goodwill, and we have that our goodwill was valued at 6,000 naira, all right. Now to enter in our goodwill account, we are going to be sharing this amount for the old partners, all right. We are going to be sharing that amount for the old partners in the old profit sharing ratio, okay, in the old profit sharing ratio, which is 2:1. All right. Now if you want to share like we do, you add 2 and 1 to give us 3. Okay, that means A will be having a goodwill amount of 2/3 times 6,000 naira. All right, this is the value of the amount that A will be getting. So that is 2 over, we are sharing this value among them in the old profit sharing ratio. So A is having 2/3 times 6,000 naira. That means A will be having 4,000 naira, all right. Like I said, this will be increasing capital, okay. And then for B will be having 1/3 times the goodwill amount, which is 6,000 naira, all right. And that will be giving us 2,000 naira, all right. Then we'll be having a total goodwill value of 6,000 naira. But that's not all. Like I said, every goodwill that we know has a direct, goodwill account has a direct impact on the capital account, all right. So if goodwill has been introduced here, then it means the capital balance also has to take recognition of goodwill that was introduced, okay. So we'll be going to our capital account next. This is our capital account. All right. So we'll be coming to our capital account next. The first thing before we will introduce our goodwill is to bring in the balance of capital, okay, for A and B that are already existing partners, okay. What they have is a balance brought forward, not really a new partner, not really a new capital, all right, but they have a balance brought forward. So we'll be bringing our balance forward from our balance sheet, all right, the balance sheet that was given. We have a balance for A to be 8,500, and then for B we have 3,500. So for our A we have a balance of 8,500, and then for our B we have a balance of 3,500. All right, now C does not have a balance because you are just coming, that person is just coming this year, all right, to join the business this year. That means he's bringing his own capital this year. He did not have any balance with us previously, all right. Now, like I said, the people that will be enjoying this goodwill are the old partners, all right. So for goodwill that was valued, okay, like I said, for our A we are having 4,000. So we're going to be crediting his capital account with 4,000 naira. And then for our B, we'll be crediting his account with 2,000 naira. All right. Now, C will also not be benefiting from our goodwill because C has not been here. All right. C has not been here unless C paid for that goodwill. All right. Unless he pays an extra amount for goodwill. All right. Before he can have that amount attached to him as his goodwill value. All right. Now, the next thing we have under the same capital account, like we have been told that C paid a sum of 4,500 for his own capital, all right, for his own capital. He paid that sum, but they didn't really tell us if it was in cash or bank. But now we only have a cash at bank balance, okay. We don't really have a cash in hand balance, all right. We only have a cash at bank balance. So in this case, it means we'll be using that bank, okay, as where he paid to. It seems that the business may not be operating with cash, all right, because it was not really stated that he paid in cash or he paid into the account. But I'm going to be using bank because from our balance sheet we only have a cash at bank balance, all right. So we have a bank where C will be paying his own capital to, okay, and he paid a sum of 4,500. This is where we'll now be having our C, okay. So if we want to balance our capital account, since there is nothing here, it means we'll just be adding, okay. We have 12,500, we have 5,500, and then lastly we have 4,500. Okay, so this is what our capital account will be looking like. So this is it for our capital account, all right. Now, like I just said, that C, right, will be bringing his capital, okay. He was bringing 4,500 into the business as his own capital. It means since we are accepting this money into our bank as capital, that also means that our bank balance should be increasing, right. So if we were having 300 in our bank, 300 naira in our bank as our balance, okay, that should be a debit balance, okay, asset, all right. We are having for the bank a balance brought forward of 300 naira as was stated in the balance sheet, okay. This 300 is the value we have from our balance sheet, and then C brought in a capital, okay, of 4,500. That means we'll be having an increase, right, and then our bank balance will increase from 300 naira to 4,800 naira, all right. This is our balance brought down, 4,800, all right. Balance brought down, okay. For the after we have already made this adjustment, we'll be having a balance of what? 4,800 for our bank. Like I said, this is a situation where, like, the first instance, goodwill is retained in the book of account, all right? So if we are retaining goodwill in the book of account, what will our balance sheet look like? All right, that's the next thing. We have prepared we have made the ledger and the necessary ledger entries like we were instructed to do, but the next thing we need to consider is what will our balance sheet look like, okay, if we are to retain goodwill in the book of accounts. Now I've shown us how we're going to be treating the goodwill right in our ledger and how it will be having a direct effect on the capital account. Now let us see what our ledger account will look like if goodwill is to be retained in the book of accounts. All right, welcome back. So like I said, we want to be looking at what our balance sheets will look like, okay, if we want to retain this goodwill in the book of accounts, right? So I'm going to be making another balance sheet, okay? This is the adjusted balance sheet, okay, at the beginning of the new year. All right, so this is our balance sheet. Our balance sheet as at 1st January 1997. All right, now we're going to be doing making our adjustment. All right, now like I said, since we are retaining goodwill in the book of accounts, we'll just be bringing on our asset. We'll be bringing in our asset, okay, but here we have to include goodwill. All right, we have to be including goodwill to our non-current assets. So we have our fixed assets. Our fixed assets, for our fixed assets, we have that land and building is 5,250 naira. Okay, and then we have that plant and machinery is 3,075 naira. So let's just use P and M. All right, 3,075 naira. This is for our fixed asset, okay? So when we add them together, we should be having 8,325 naira. All right, that's it for fixed assets. All right, now before we bring in our current asset, we have to bring in our goodwill, okay, which is an intangible asset. So I'll be bringing in our intangible asset. So our goodwill is an intangible asset, which is 6,000 naira. All right, now we'll be having a value of 14,325 naira. This is what it means for goodwill to be retained in the books. That means we're going to be including it in our balance sheet. All right, and then we can now go to our current assets. Our current assets, here we have stock. Here we have our stock, and our stock value is 4,500 naira. Our debtors value, the net debtor value we have is 2,850. So let's just say the net debtors, okay. All right, and then for our cash at bank, okay, our cash at bank, like I said, we have adjusted our cash at bank, right? So we are now having a value of 4,800 naira. Okay, so we are bringing in, instead of 300 that was given here, we are now bringing in 4,800 because of this additional 4,005 that was received from Mr. C. Okay, so we are having our cash at bank be 4,800 naira. So that will be giving us a value of 12,150 naira, okay, for our current asset value, right? Now let's check in our current liability so we can have our working capital, okay? So for current liabilities, the only thing we have there is our creditors value. Our creditors value, and it was told us our creditors value is 3,975 naira. So we're going to be deducting our current liability, right, which is our creditor, to arrive at our working capital. So after deducting this, we'll be having 8,175 naira as our working capital, right? After we have added our working capital to our total non-current assets, we're going to be arriving at a value of 22,500 500 naira. All right. Now the next, let us sum up our capital and see if we have a balanced account. All right. So let us look at the finance section. All right. So for our finance by, which is for the equity, right? We'll be bringing in our capital. We bring in our capital. For A, we have a balance, okay? A balance that was after we have made adjustments for goodwill. Like I said, we are retaining goodwill in the book of accounts. So after we have made adjustment for goodwill, we arrived at a value of 12,500 naira. Okay, for A. For B, after we have adjusted for goodwill, we arrive at a value of 5,500. And then lastly for C, okay, C was the person who brought in just capital, right? He's not benefiting from goodwill. So for C, we have 4,500. Now after we add, we'll be arriving at that same figure, which is 22,500 naira, all right, which is giving us a balanced account. So this is how our account will look like, where goodwill is retained in the books, okay, where we want to retain goodwill in the book of account. This is how our account will be looking like. So in our next video, we'll be looking at how we'll be treating or how our balance sheet or how the account will look like where goodwill is valued but not retained in the books. Okay, now don't forget to like this video, subscribe to this channel, subscribe to all our social media handles if you haven't, okay, and then share our video with as many as you can. We'll see you in our next class. Thank you.